Welcome to another episode of Map Your Money. I'm one of your hosts, Arish Nurani. I am joined by our two crypto experts today. CFP and managing partner Jaime Benedetti is joining us, as well as CFA and Chief Investment Officer Jeff Cohn. How are you guys doing today?
Doing great, Arish.
Doing great.
Good. Well, want to start with an icebreaker as usual. When by the time this comes out, I think it'll be pretty close to finally seeing sunlight after 4 p.m. with daylight savings going back. I talked about this with a client earlier today. But are you guys in favor of getting rid of daylight savings completely if you guys were in office?
Jeff, I'll let you take this one.
Getting rid of it, does that make the next change permanent or a current state
Not
permanent?
making current permanent. Making it to where we have sunlight after 4 p.m. because
I can get down with that.
Yeah.
Yeah, I mean, it seems like cutting off, one piece of fabric and then tying it on the other end, right? So I'd rather have my sunlight in the evening. I've been having to take my dog for a walk at 4 p.m. here in Ohio to make sure I'm not out walking at dark. So yeah, I'll take that all day.
Yeah, I'm a big fan of having sunlight longer, especially in the evenings. But I know that the opposite case is a lot of morning people like it in the morning. Do you have a big take there, Jaime?
I know that there was a really rational reason for implementing daylight savings like 200 years ago, and I don't know what that is. So I'm only giving my personal opinion.
Yeah, that's what matters.
I prefer to have sunlight in the evening. I think it sucks getting out of work and it's dark, especially if you work a lot and you go in, it's dark, you leave, it's dark. It makes for a long winter.
For sure. And I want to say the reasoning was something about farming, but I tried to look stuff up about that before and really couldn't find a real reason. I don't know. I'm sure there's a listener who's going to be like, oh, there's this exact reason, but it doesn't really make a ton of sense today.
I think Ben Franklin invented it.
Really? Okay.
Yeah,
I think so. I could be
I've
wrong
heard
about that.
Yeah. So a little context. So I do think it was related to agriculture, to like getting farmers that extra daylight. Some people say it's like school bus schedules for kids having that daylight while they're out there waiting. But one of my college professors in college actually did a study on whether daylight savings actually made workers more productive and found that there was no statistical relationship. So
there you go.
There you go. We can do away with it.
All right. Sounds good. Well, let's get into what we're here to talk about. I mentioned the two crypto experts. Obviously, you guys do a lot more than that. But want to talk about the spot Bitcoin ETF. It's something we've alluded to a lot in the past. But let's run our intro and then let's get into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right. So like I mentioned, we've alluded to this spot Bitcoin ETF. And if I'm saying those three words, then you're already lost. No worries. We're going to explain. But this is something that we've alluded to in past episodes and something that we've planned for as an investment thesis. So Jaime, do you want to explain what the spot Bitcoin ETF is and what this being approved means for investors?
Absolutely. So prior to this, you could buy Bitcoin in an investment account, in a retirement account, through an ETF. The problem was the ETF didn't actually buy Bitcoin. It tried to get you Bitcoin exposure by buying Bitcoin futures, which is a really inefficient way to do it. There's additional costs. It doesn't track the price exactly. There's a whole bunch of reasons why it's just not a great product. So the question is, why was this even approved, or why was this the only way we could get exposure in a portfolio? And the answer is primarily political reasons. For a lot of different reasons, the SEC didn't want this product. Ironically, they allowed a futures-based product, and this ultimately went to court, and the court sided in favor of Grayscale, and they said the SEC was being arbitrary and capricious, and that they needed to provide a better reason for denying this ETF product. And ultimately, they approved it, they approved multiple spot Bitcoin ETFs. So what it means is that now these ETF products actually buy Bitcoin. So you're holding Bitcoin. Why is that important? Well, there's a lot of practical reasons. If you want to have Bitcoin as part of your portfolio, you could have always gone to Coinbase and bought it, but you can't really do that within your IRA, at least not easily. And that's where a lot of investable assets are. And so if we think about what this means, there's an economist named Raoul Pal. Jeff, you may be familiar with him. I think he's a British economist, but he incorporates crypto into his macroeconomic points. And he had this really good analogy of describing the significance of a spot Bitcoin ETF in the United States. And he said, it's like a free trade zone between the Bitcoin and crypto economy and the traditional finance economy. So if you kind of run with that analogy, you think of two countries, and they're not friendly to one another. Think China and the United States during the Trump years. China issues tax on importing U.S. goods. U.S. issues tax on importing Chinese goods. It's not very profitable for the two countries to do business with one another, and you're just not going to see a lot of trade. Now they both implement a free trade zone, meaning no tariffs on U.S. goods, no tariffs on Chinese goods. You're going to see trade improve a lot. And that's kind of what's happening between the crypto economy and the traditional finance economy. You're going to see a lot more asset flows back and forth as a result of the spot Bitcoin ETF.
Yeah, definitely. And I know you mentioned kind of the ability to now own Bitcoin in an IRA or in these different accounts, where in the past you could only do it with after-tax money in Coinbase or wherever it might be to own the actual Bitcoin. I know we've talked about how we got exposure prior to this with these futures-based products. And I think it's allowed to pat ourselves on the back for that one, because I went back and listened to our episode about a year ago in April, episode number 3. And Jaime, you were talking about how we got exposure with those future-based products and had this ability or this investment thesis that we believed a spot Bitcoin ETF and a spot Ethereum ETF, which hasn't yet been approved, but still our thesis there would lead to a discount being closed. And that's exactly what happened. But all of this to say, I know we're now our thesis is we're going to see a lot more inflows, or we believe to see a lot more inflows into cryptocurrency, especially Bitcoin, because of the ability to easily invest into it in your Charles Schwab account, in your Fidelity, whatever brokerage you might have. It's a lot more common and a lot easier to do and own the underlying asset now.
Yeah, Arish, I'll make one small correction there, and then I'll pat ourselves on the back. And that's it. We never used the futures-based product. We didn't like it. We thought it was a bad product. What we actually did, we kind of stuck our neck out for clients because we thought it was the right thing to do. We bought GBTC, which was it's a private trust that was trading on the secondary market. And one of the reasons we liked it so much was it was trading at a deep discount to the value of the underlying Bitcoin. At some point, we bought, at one point, it was a 40% discount, meaning you could buy the shares for 40% less than the value of the Bitcoin that the shares owned. And so we felt like it was an additional margin of safety for our clients. And we thought, it's only a matter of time before, I guess, common sense prevails and the rule of law prevails in the United States, and a spot Bitcoin ETF gets approved. When that happens, that discount to NAV is going to close. And, it was a really... it could have taken longer, but we felt like it was a really contrarian yet very safe bet.
Yeah, definitely. And thanks for that clarification there. I think that's really important as well. Jeff, I know you haven't been on a crypto episode in the past, so happy to have you here. I know you were able to find some data on the inflows that we're talking about into cryptocurrency. So do you want to quickly touch on some of those points there?
Yeah, sure. So there's, as Jaime mentioned, I think there were, 11 products that were approved, Jaime, by the SEC, the spot Bitcoin ETFs. A couple of big names have entered this arena. BlackRock is a pretty big one. Fidelity, ARK Invest is maybe an asset manager that some listeners have heard of with some hypergrowth stocks. So they're all in this arena. There's also some other companies that maybe the listeners have not heard of. Bitwise is a crypto-only asset manager that has a lot of expertise in the space, and they have one of the cheaper ETFs. And then you also have ETF powerhouse like VanEck, and then Franklin Templeton asset manager conglomerate at this point that also has an ETF. So if you look at all these, the one that's brought in the most inflows is actually the iShares Bitcoin Trust, ticker IBIT. So that's from BlackRock. And the year-to-date flows as of yesterday were $3.5 billion. So they're doing pretty well over there. And second, you actually have the Fidelity Wise Origin Bitcoin Trust, FBTC, which has brought in close to $3 billion, just under 3 at 2.9 billion. And then after that, it kind of trails off to ARK, 791 million, Bitwise, 756 million. And then from there, quite a large drop to Invesco at 270 million. One thing that I think is interesting to point out here, a lot of inflows into a lot of these spot Bitcoin ETFs, but we also have to consider one of the ETFs has a large outflow, and that's the one that Jaime mentioned before, GBTC. While the trust did convert to a spot Bitcoin ETF, the trust was charging about 2% management fee, and they only lowered that to 1.5% for the ETF. And so this is one of the most expensive ETFs out there, and you're seeing them pay for it in flows with 6.2 billion in outflows year to date, and that's 500 million outflows just last week.
And for the record, we've done the same thing. We've liquidated our GBTC position now that there are alternatives that are 90% cheaper.
And when we talk about crypto and portfolios, this is only applicable to BGA Wealth and not Beam Wealth Advisors. So that's an important clarification there. But yeah, so we've kind of seen all of these inflows into a lot of these products, and we believe we're going to continue to see that. As you mentioned, Jaime, this is becoming more of a connection into traditional finance, into this ability to easily invest. And so I think it's important as a company who's investing money for our clients to talk about, I know we've talked about it in the past, but our rationale for still wanting to have this exposure. We've mentioned that in the past, we wanted to have this exposure partially because of that deep discount that we were able to get into. What's another reason why we still want to have that exposure now?
So I would say there's actually two very, very compelling reasons. One has to do with just the fact that Bitcoin as an asset class isn't correlated, or at least has very, very small correlation, and we can expound on that. But the other one is that we actually believe that Bitcoin, the price of Bitcoin is still going to go up. Now, I always throw this caveat: it's an incredibly volatile asset. It could go down 50% tomorrow, but over the next 3 to 5 years, there's a lot of fundamental reasons we think the price is going to continue to appreciate, not the least of which is this spot Bitcoin ETF. So Bitcoin has one thing that no other, let's say, government-issued currency has, and that's scarcity. There's a finite amount of Bitcoin, 21 million. There will never be any more. It's programmatically enforced. And so what does that mean? As more and more as Bitcoin becomes more popular, more and more people want to buy it. As more financial institutions buy a spot Bitcoin ETF, which means they need to create shares, and they do that by going out and buying Bitcoin, there's more and more people chasing the same amount of Bitcoin, and that will inevitably lead to the price going up as adoption increases.
Yeah, and Jeff, I believe you had some stats on kind of risk versus return of crypto or Bitcoin specifically.
Yeah, so for us, it's all about risk management. We obviously want to make a good return for our clients, but we want to understand the risk of the securities that we're putting in the portfolios and understand how they correlate to the other securities in our portfolio. So when we evaluate an asset, we're looking at its return, its expected return, its risk, and then of course its correlation to other assets. And if you have an asset like Bitcoin, obviously Jaime mentioned the volatility. It has about 4 times the volatility of the S&P if you look at standard deviation over the past 3 or 5 years, but also just the total drawdown of Bitcoin. The peak to trough price movement is quite a bit higher than you'll see in equity. So for instance, in the last 10 years, Bitcoin has had 4 drawdowns of 60% or more, including 2 drawdowns of 80%. So this is an asset that you can lose a lot of money on if you invest at the peak and then you sell at an opportune time. So I think the first thing to point out is that this is a very, very risky asset. The asset class in general is beyond the risk even associated with equities or private equity. It's really on a spectrum all of its own. But luckily, the return is also on a spectrum all on its own. Since inception, Bitcoin is up 248,000%. So definitely better than the S&P 500. Over the last 10 years, 8,160%, 5 years, 1,230%, and even in just the last year, 120%. So the returns are definitely compensating investors for the risk if they can stomach it. But The really important point, and Jamie mentioned on this, is that the correlation is low compared to other traditional asset classes, which means you're getting this return at different times than other parts of your portfolio are giving you return. So what that means is as you add Bitcoin to your portfolio in small amounts, the return of your portfolio is going to increase, but the actual overall risk and volatility stays about the same. And what that means is your Sharpe ratio, or the amount of return you're getting for the amount of incremental risk you're adding on, that Sharpe ratio is a lot higher with Bitcoin. And so here, Bitwise did a study that if you add a 5% allocation to Bitcoin and rebalance quarterly from January 1st, 2014 to July 15th, 2022, that it only added 1 percentage point of additional volatility, but 2x'd the Sharpe ratio, 2.5 times X the Sharpe ratio. It went up from 0.194 to 0.58. So I think there is still a compelling reason for Bitcoin. Not only do we think the price is going to go up and that it's scarce and that's going to drive a lot of its value, but also from a portfolio management standpoint, it has some of those characteristics that we look for in including new assets into the portfolio and delivers positive results for clients.
Anything you want to add there, Jamie?
Yeah, I would actually say that the volatility in Bitcoin is a feature, not a bug. It's no different than any other asset class in our portfolio. We're investing for the long term. It's a buy and hold strategy. We want to be opportunistic and buy when things are low and sell when things are high. So it's really no different, for example, from an equity. If we have a client that doesn't have a long-term time horizon, we're not going to put a lot of their portfolio in equities because we don't know over the long run. We're very confident we're going to get a good average return, but we don't know what years those returns are going to come in, and there's going to be a year where they're down. Now with Bitcoin, it's even more so. But as part of a diversified portfolio, and particularly in a small amount, that volatility is, we can really use that to our advantage by rebalancing, right? If Bitcoin doubles in price, we trim it, take our gains off the table, and we invest it in something else that's gone down. If Bitcoin then falls by 50%, we take gains from something else and we buy it when it's half price. And doing that year in and year out only adds to our overall return. So Jeff is absolutely right. It's a very volatile asset, but again, the appropriate amount in a portfolio, we would argue, is a small amount. And there are numerous studies that have looked at this. There's ARK Invest just put out a white paper, they came to slightly different conclusions, but ultimately they were arguing that, between a 2 and a 6% allocation is ideal, that a 2% allocation actually decreases the overall risk in a portfolio, and you go as high as 6%. That's where you're kind of optimizing the return. We would err on the side of caution and probably have a smaller amount, particularly for retail clients, because that one of the differences between investing individuals' money and in investing for institutions is that individuals tend to react a lot more emotionally, and we have to have a lot of those conversations justifying why we did what we did and why we need to stay the course when things aren't going well. Whereas institutional investors, they're typically just much more cold and calculated, and there's an investment committee involved making decisions, and they'll write it out. They have a longer time horizon, and they can afford a little bit more of that volatility.
Sure, yeah. Want to kind of take a step back there and make a concluding point, because I know we just spent a couple minutes talking about the extreme volatility that there is in Bitcoin and in cryptocurrency. With these really high highs and these really low lows, but over time we've seen these massive gains. And so I feel like a conservative investor could be listening here, or a moderate investor, and say, oh, crypto's not for me. It has these huge jumps and swings, and sure, it might have done well over time, but I can't endure that in my portfolio. But Jamie, what you're kind of saying here, and Jeff as well, is that this correlation to the underlying assets, to the other assets in their portfolio, is so different that it actually helps with diversification. I know I've ramped up on diversification so many different times. And if we wanted to just get one return and maximize that return over a period of time, we could maybe just say, hey, let's just invest all of our money into tech, into Apple, into Tesla, whatever it might be. But we're not diversified. I know many of our listeners have heard kind of the reasoning there, and we take that one step further into the different sectors of the market. And then another asset class completely, which is diversified from the market returns that we're going to see in the stock market, in the bond market, is this asset class of cryptocurrency. And so even by adding something so risky of an asset class like cryptocurrency, it can actually bring your overall portfolio risk down if done correctly.
Yeah,
I would agree with that statement.
Okay.
If done correctly, but this is really important. Go ahead, Jeff.
Yeah, sorry, Jamie. So one thing I would add on is that relationship, that low correlation is improving over time. Before crypto was kind of behaved somewhat like a speculative asset, right? Like I remember 2017 going into 2018, it was very speculative, and then it had a pretty big crash there. And then as you saw more and more institutional acceptance, you saw more asset managers give approval. You saw the futures-based product get approved by the SEC. You started seeing Bitcoin trade as a little more of a legitimate asset, and an asset that trades similar to like gold, right? To where it's almost something that you could put in your portfolio in case people kind of freak out or panic and get scared. And we actually saw that work out well for investors last year during the March SVB debacle, where banks were collapsing, the S&P was collapsing, and risk assets were selling off, and flight to safety assets were doing really well, but also Bitcoin did really well, which is not typically considered a flight to safety asset. So I think it's not only that Bitcoin has those characteristics, but those characteristics are actually improving over time.
Definitely. And I know earlier in this episode, we mentioned kind of Coinbase and Kraken and how you were only able to use after-tax assets to be able to invest into Bitcoin at that point and own the Bitcoin. But I know throughout this episode, we've also mentioned the ability to rebalance and sell some and move that into other parts of the portfolio. So Jamie, do you want to touch on kind of the ability to better do that within traditional brokerage accounts now, rather than one of these other crypto specific brokerages?
Yeah. So, the ability to buy Bitcoin, whether it's through Coinbase or through some of the other exchanges inside of an IRA, has been around, but it's very clunky and very expensive. And ultimately, you can't rebalance, right? Well, at least not easily, because these are specialty custodians that allow you to do that. This is a much, much simpler approach. You can buy this in the same account that you buy an S&P 500 index fund, and it allows you to easily rebalance, which means that for the average financial advisor whose client, whether or not they have a predisposition to include this asset in a portfolio, if their client's asking them about it, it's much more easy for them to be like, oh, okay, I'll buy the BlackRock ETF. I know BlackRock. I'm comfortable with them. I have a bunch of iShares. Or I'll buy the Fidelity ETF. And you know what? We'll do a small percentage and it'll appease my client, even if I don't have a lot of conviction around it. And then I do think that this creates a virtuous cycle. As it becomes more normal, more advisors are going to go, well, maybe I should look into this and I should kind of understand what this is and why there's such, why are people buying this? And it gives, it ultimately makes it more mainstream, and it gets to the point where other advisors that haven't been using it now feel like they need to, because they're the only ones that aren't using it. And it creates this virtuous cycle of ultimately it just becoming more and more mainstream.
Agreed. And I think it's kind of like a domino effect in terms of what we're going to see here in this landscape. And this spot Bitcoin ETF being approved, I think, is one of the really big dominoes falling and saying, okay, now this is going to be a conversation that a lot of other asset managers are going to start to have because their clients are going to start asking about it. Something we've been on the forefront for a little while now. But I know across mainstream finance and wealth management, it's going to become more top of mind. And so it's definitely a big domino there. And then I think another domino will be the Ethereum ETF, spot ETF, which I'm sure we'll cover in the future in terms of once we see that start to be approved or legislation coming out with that as well. So I think there's always a lot of change happening in this space, but it is an important asset class, and I think it definitely has utility in client portfolios, and it's something that we've been aware of and been doing well for a little while now. And so going to continue to do this. Is, again, another big domino here, and something we'll continue to cover on the podcast. But any other last points that either of you want to make about the landscape, cryptocurrency, spot Bitcoin ETF?
Yeah, I'd like to make one. You mentioned it yourself, which is the Ethereum ETF.
Yeah.
Part of the reason that this took as long as it did, and I would also argue that part of what fueled the crypto debacle we had with Sam Bankman-Fried and FTX was the fact that there wasn't an easy way to buy this, and it created this, not to get too into the weeds, but it created this GBTC arbitrage opportunity that people levered up, and ultimately it just caused a bigger collapse, right? And the reason we didn't have a spot Bitcoin ETF earlier was strictly for political reasons. Without getting into the politics, I do think Larry Fink of BlackRock deserves a big shout out, because he was one of the first, not the first, but one of the first individuals from a traditional financial institution to really say, hey, this is silly. It doesn't make any sense. It's hurting the consumer. And he really put a lot of pressure on the SEC to make a good decision. And what we're seeing now with the Ethereum ETF is essentially the same thing. It's the same story playing out with an Ethereum ETF, where we have futures-based ETFs and we don't have a spot product. So, our prediction is that it's the thin end of the wedge, and a spot Ethereum ETF is coming. Again, it could be in 6 months, it could be in 6 years, but it only makes sense if they're allowing Joe consumer to buy an inferior version of this product. It only stands to reason that if they're really looking out for customers, that they would let them have a better version of it.
Definitely. Well, awesome. Jeff.
Well, I have one more point, or if you'll let me.
I will always let you.
I hate to make you work overtime here, but Jamie, I got a question for you to wrap it up. Other than Bitcoin and Ethereum, which crypto asset or digital token do you think is going to have the most impact or see the greatest growth in market value?
Oh man, that's a tough one, because Ethereum and Bitcoin are sort of in a league of their own, in the sense that you can really make a case that there's already product market fit. They're the dominant players. Collectively, they probably account for over 90% of the crypto market capitalization. So while I do think there are still big gains to be made in both of those cryptocurrencies, they are not the ones that are going to have the biggest gains. There's going to be another smaller one that likely has a lot more upside. But that is a much, much more speculative bet. And there's a couple that are on the radar that I think are like top 10. Solana has been in the news a lot as an Ethereum competitor. In fact, in 2023, they were the best performing crypto asset class, beating both Bitcoin and Ethereum. But there's a little bit more risk there. And there's some other ones as well. I hesitate to name names because they're just not. They're ones that are on my radar, but I just don't know enough about it, and I would make a case that it's a much more speculative bet. Yeah, but if I had to pick one, I'd say Solana. Solana or Cosmos is another one that I think has some potential. But again, very, very speculative. They could go to zero.
Yep. You're saying might as well go to the roulette table.
More like poker table, but just know you might be sitting across from Phil Hellmuth or some other sharks.
There you go.
Nice.
Well, Jamie and Jeff, appreciate your insights as always. Again, this is something that we're going to be covering and watching as a firm, as well as talking about here on the podcast. But thank you guys for joining, and thank you to the listener for tuning in.
Thanks, Arish. Great talking about this.
All information provided through this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside Benedetti, Gooser & Associates and Beam Wealth Advisors. All examples are hypothetical and for illustrative purposes only. Benedetti, Gooser & Associates and Beam Wealth Advisors do not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.